Welcome, everybody, and I just wanted to thank everyone for joining us today as we kick off what we feel or what we understand to be a very important topic, which is electionomics and how we can decode the impact of the elections on the financial markets. I know the closer we get to election day, we're being inundated with commercials, texts, phone calls, almost nonstop. And so, just that's why we wanted to cover this topic for everyone. And just a quick note, we are intending to make this completely nonpartisan um, as we kind of go through this conversation. That's why we have a number of guests, both in-house from Fort Pitt Capital and independent of Fort Pitt. So real quick, commercial for what we do here. At Fort Pitt Capital Group, we offer a boutique wealth management experience where we have a holistic approach to financial advice while maintaining transparency and our duty as a fiduciary. My name is David Plante. I'm a financial advisor here at Fort Pitt Capital, and I will be your host and moderator. So as we meet our panelists, here next to me, we have Brad Newman. He is one of our senior financial advisors here in the Harrisburg office. Out in Pittsburgh, we have Daniel our chief investment officer, who is responsible for guiding our investment strategy, and also Chris Bardo, one of our senior investment analysts. As I mentioned, in the spirit of being holistic, we have a couple of outside guests as well. Lenny McAllister. Lenny McAllister is a veteran in the political realm with a unique range of experiences from working with the Republican National Convention to the Urban League and Rainbow Push Coalition. Burwood Yost is the director of Center of Opinion Research, and he has experience in polling and tracking public attitudes towards public policies along with their political campaigns. Just some housekeeping and how to interact with us today. If you are on an iPad or an iPhone or any kind of device, just tap your screen to ask a question or to get the handouts. You can see it right up here in that little chat box there. And if you're on a computer, you'll notice you can you can get the questions and handouts right here. Just put your question in the box, hit send, and we'll try to answer as many as we can. So with that, I'd like to kick this off to Dan, and Chris Bardo to start the presentation. Chris, Dan?
All right. Thanks, David. Welcome, everyone. Just a few comments from me, and then I'll turn it over to Chris for some more in-depth thoughts. But as our clients know, we're long-term investors. We don't tend to make massive moves in portfolios based on short-term events or bets around political outcomes. It's very easy to be very wrong on those views. And a much more prudent and successful approach, in our opinion, is to take a long-term view on markets and really keep the focus on investing in great businesses. And along that same line, we're big believers that each of our clients' asset allocation decisions should really be based on their unique circumstances around their goals and objectives, and factors such as liquidity needs and their time horizon, and not based on short-term views on the market direction or election results. Also, we make our stocks selection decisions based on factors such as the fundamentals of the business, our assessment of company management, what we think the company is going to earn over the next 3 to 5 years, and what type of valuation that we're willing to pay for that earnings stream. I always get a bit of a chuckle out of strategists that attempt to identify which areas of the market will do well or poorly based on certain political outcomes. I think that completely ignores the fact that markets are so multidimensional, and that it's often the third or fourth derivative that no one predicted that can really have much more of a significant impact. And as far as volatility, Chris has a really good slide with an overview of how markets have historically performed, before and after elections. Unsurprisingly, markets tend to exhibit, higher than normal levels of volatility in the 3 months or so that lead up to presidential elections. That combined with the fact that October is traditionally a rough month for the stock market. I think a good baseline expectation is that we could have some choppy markets in the near term. But I think one of the biggest takeaways from the charts that Chris will go over is that markets have tended to move past those election related bouts of volatility in pretty short order, unless there are some bigger, longer lasting problems in the in the economy or financial markets. Dave, you want to forward it? There we go. So not that we're making any big bets on the outcome here, but in terms of how we think things will shake out at a high level, first, we believe that the composition of Congress is an extremely important part of the equation. And we think that, some form of divided government is the very likely outcome with the election, and probably a pretty good explanation as to why the market really hasn't exhibited too much, volatility heading into this election season. And in that divided government type of outcome or scenario, it does become very difficult to really pass through, sweeping transformative changes. So I think it's safe to say that the markets are viewing the divided government outcome as the most advantageous outcome here, and we would agree. And finally, as we all know, markets hate uncertainty, but the stock market has lived with 4 years of a Trump presidency and 4 years of a Biden-Harris administration. So I think we do maybe get to remove some amount of the uncertainty that the market usually grapples with before a presidential election. So Chris, over to you.
Yeah, thank you. Thank you, Dan. Thank you for everybody being here today. So on this slide, we're going to go over kind of the core tenets of what we think the Trump presidency will be. And I think for both candidates, we've kind of already gotten that view from 2016 to 2020 with Donald Trump, and then 2020 to 2024 with the Biden-Harris administration. So we kind of have a flavor of what each candidate will do in office. So one of these bullet points is lower regulations. The Republicans tend to run off of a lower regulation for small, medium, and large businesses. And when President Trump originally won in the election, he did deliver on his promise to roll back small, medium, and large business regulations. And the Economic Advisor Board, Council of Economic Advisors, essentially came out with the estimates that this will give middle-class families basically a $3,100 per year household income bump. So we can kind of see how rolling back federal regulations could potentially boost household income. And right now, sort of in this macro environment with costs soaring, that could be very useful. Essentially lower the taxes on the consumer, which I think the majority of people could agree with right now. However, we then run into the issue of broader and steeper tariffs, and not just on China. So when he was running in 2016, he coined himself Tariff Man. We all know that terminology. When he won, he ended up putting the tariffs on China, and they were pretty hefty tariffs. And essentially, tariffs are going to be a tax, and it's going to be an indirect tax on consumers as well. So prices will have to eventually go up so companies can offset what that import cost would be. And the kind of tricky part about this is when Biden ended up winning, he kept those tariffs on. So they never necessarily went away. So corporate profits ended up adjusting for them. However, 2024 to 2025, the Biden administration is also increasing tariffs on specific goods and coming in from China. And this includes semiconductors, aluminum, electric vehicles, batteries, minerals, solar cells, and a ton more imports from China. However, the biggest difference between the two policies is Trump would also enact a tariff, a global tariff, because he wants to bring manufacturing back to the United States, give the United States citizens jobs in manufacturing and services. So both administrations right now are pushing for tariffs. One side just happens to be pushing more off their policy stances. And then for taxes, corporate taxes probably stays the same under Trump, around 21%. He will probably extend the individual tax cuts as well, potentially make them permanent. And then the child tax credit as well most likely extends that, with the exception that they will require work requirements for that tax credit. So moving on to the Harris presidency and how that looks, most people and most articles that I have read, that probably most of us have read, is we kind of think that it's going to be an extension of the Biden administration. And I know that Vice President Kamala has tried to distance herself from the Biden administration and create her own platform. However, majority of people aren't feeling that way. It feels like it will just be another 4 years. And it may. We don't know for certain, obviously not yet, but nothing she's really said or done or released policy stance-wise has been that drastically different from what they've already been doing the last 4 years. So we think, in terms of the markets, that probably creates some sort of complacency where, okay, but market did well under the Biden administration. Maybe we just get sort of this continuation of the market if she does happen to win. So the Harris administration potential, they are targeting tax increases, obviously, on those who make the highest income in the United States, the top 1%, top 5%, essentially anyone making over $400,000 a year. So this is kind of like a sticking point that the Democrats like to build their base off of, is the pay their fair share. So we could dive into the pay their fair share later, but essentially the top 1% already pays around 45.5% of the federal income tax. The top 10% pay around 65.6, or the top 5% pay around 65.6, sorry. And then the top 10% pay around 75.8%. So if she does end up increasing the top income tax bracket, what's the incremental benefit to that when our deficit is still over $1 trillion in spending per year? That's a question that hasn't necessarily been answered yet. Both candidates are also spending a lot, and something has to happen at the government level to decrease that amount of spending. You can go to the next slide. So one of the common questions as an analyst I get from clients, friends, family is sector bets. And we don't like to use the word bet in investing because we like to value a company based on its future free cash flow. However, there's this common misconception of what you think will happen versus what will actually happen or tends to happen. So let's say a Republican wins, you would think hypothetically that defense sector does very well, or natural gas and energy will do very well. But as you can see in this chart here, after Donald Trump won the presidency back in 2016, the S&P Energy Index actually underperformed and the Clean Energy Index outperformed. It actually did very, very, very well, as you can see, up 275%. However, that shift when Biden won, the energy sector, not clean energy sector, ended up outperforming, and clean energy actually underperformed drastically. Now, there's a lot of independent variables that could have played into this. Um, Another one of these common misconceptions about which side wins the presidency is fracking, drilling for oil. The Biden administration has actually approved almost double the amount of drilling permits that the Trump administration um, allowed. So you kind of have this, things continue to go the way they go, but politicians, they like to point out certain things that drive their base. Whereas as an analyst, we kind of look under the hood on both sides and we just look at the numbers. And the sector bet, you can kind of look at the numbers here. Trump was always about drilling, drilling, drilling. However, the energy prices went down, or the energy stocks went down. And then Biden was against fracking and drilling, and it's up 200% off those Trump lows. So it's kind of an interesting inverse correlation, but it's something that we have seen over just decades of market research.
Chris, if I can just ask, what do you think explains that? Just the fact that they're
So,
wrong, or
so Dan, you could fill in here too if you want a little bit. January 2020 obviously was COVID, right? So we had this major, the government basically shut down the economy. That's what happened. And the Federal Reserve slashed rates to zero and printed, I believe it is something of 90% plus of the current money in the market was created after 2020. So you had this massive amount of liquidity, and that liquidity has to go somewhere. And clean energy, while highly unprofitable right now, you saw after 2020, clean energy stocks, unprofitable tech companies do very, very well because that liquidity has to go somewhere. So you could buy the Apples, the Amazons, the Googles, or you can take bets on clean energy. Maybe it pans out in 20 years or maybe it doesn't. But I think that's kind of what explains the discrepancy between the two, because why own a finite resource when you can bet on clean energy, whether it's nuclear or wind, solar. So you kind of have the bet mentality when it's going into that.
Yeah,
Dan,
and I would just say that those are the type of the third and fourth derivatives that I talked about that no one's going to be able to predict, you know, on election day. So
right.
I think there's a lot more to the equation in terms of what drives sectors and the performance of companies besides just who wins on election day. I
Right.
think this is a very good example of that.
So as you can see, and in recent days, the market has been hitting all-time highs. So, since inception, the stock market has essentially gone up and to the right. And while it's easy to say, there are periods of time where the stocks are flat and you accumulate at cheaper valuations. However, in this chart, you can see the S&P 500, which is the index that we're going to use. The average return under a Republican presidency is 12.9%, Democrat 9.3%, and a divided government, which we've seen a lot more of in recent years, 8.3%, which is 61% of the time. So this concept of, is if Donald Trump wins, should I sell all my stocks? History proves you probably shouldn't do that. Should I sell all my stocks because Kamala's going to raise taxes to 45%? Probably not, because a divided government most likely won't allow that to happen. So to kind of Dan's first couple slides there, gridlock is normally, probabilities are in your favor. And then second, it kind of does exactly what it says. The grid is locked. I mean, you have either a Republican House or a Democratic House, vice versa for the Senate, and certain bills and certain, what's the term I'm looking for, compromises are going to have to happen, bipartisan deals like we saw in the infrastructure deals. So stocks long term are most likely your best inflation hedge as well. However, you have these one-off scenarios where it is irrelevant of the man or woman in the office. It is a completely independent scenario that happens, such as the tech bubble and the great financial crisis. And I might not be old enough to remember either of them, but I study a lot of data and history in the stock market, and these are kind of just scenarios where you have underlying variables that have nothing to do with the person in the office or the divided government. This is separate from that. So you can also see here from election day, the S&P indexed 100 days prior, and two, you have events bringing it down, which towards election season, the stock market is slightly more volatile. I believe either August or October are the most volatile months of the year historically. So you have seasonality that plays into it as well. I mean, you have tax loss harvesting, mutual fund changes, asset allocation changes. But you can see there, the blue and the goldish yellow is 2008 and 2000. So probabilities are just very low. And even those weren't a time to necessarily sell stocks. They present opportunities. And we at Fort Pitt try to look for opportunities versus fear and selling into fear. As Dan was kind of saying in the first couple slides, the markets focus on a few core things over time. Corporate earnings, which is very, very valuable. Corporation at the end of the day has to make money and return it to shareholders. So corporate earnings are set to grow next year. I think the current estimates are around 15, 16%, might be a little high. But the market will shift back to that after the election. And you have inflation that we just got a report this morning, and it was slightly higher than estimated. So the market was down a little bit. Not sure what it's doing exactly at this moment. And then you still have the Federal Reserve policy. Jerome Powell, his tenure will be up here soon, and whoever wins the next presidency will have that power to put someone new in that chair. So the market will, right after the election, it will find something new to focus on. And these are more short-term worries. And we can't get caught up emotionally or get caught up too much in the numbers in such a short period of time, because we have very long-term clients, and we don't just shift a portfolio because we think someone's going to win or someone's going to lose. That's not the right thing to do as a fiduciary.
So, with that, Lenny, Burwood, I heard a lot from Dan and Chris about divided government. What are your thoughts as far as, with how it relates to the political side of things, of why that drives the market or that helps the market?
Well, first and foremost, it makes the market a little bit more predictable, because if there's less policy being shifted in a dramatic way, something that's a complete break from the norm, there's more of an opportunity for an analyst to study the gradual methodical trends that are there, and then be able to make more insightful decisions. One of the things that people have to remember is that if Donald Trump wins the presidency and he has divided government, one half of his second term, remember, he'll be term limited at that point in time, one half of his second term will be with divided government, where there's a very strong likelihood that there's not a whole lot to get done. If Kamala Harris comes into office, yes, she could possibly be in there for 8 years. But again, if she comes in with divided government, she's for 1/4 of her term not be able to do the things that she may be campaigning on right now. Let's go back to 2008. Chris had an opportunity to show a really great chart about how the numbers went down in 2008. Barack Obama comes in as the 44th president of the United States in 2009. He literally only had about 14 months to put in Obamacare, cash for clunkers, some of the policies that you remember about the Obama administration. It was a special election up in Massachusetts where Scott Brown won the late Ted Kennedy's Senate seat that got rid of the supermajorities that Democrats had. So from there, you had the Tea Party race of 2010, and you had the Republicans taking over the U.S. Senate in 2014. A lot of the economy coming back from 2011 through 2016 with job numbers and unemployment coming down after the Great Recession was done with two big things politically. One, divided government, and two, a sequester. So it kind of goes back to the whole premise of with divided government, there's a way to kind of control the types of policies that will actually be passed, the things that will actually impact how companies react, and then subsequent to that, how financial investors will be giving advice as to what to do next.
Excellent, excellent. And Burwood, for you, what are some of the, they mentioned some of the big policy, well, with the divided government, there won't be that much policy changes, but what are some of the policies that your polls show that people are concerned with and actually drive voters?
Yeah, first let me say, Chris, that was a great review. Myself, I'm an investor, and so it was. I usually look at things as a political scientist and a social researcher, so I found your analysis quite interesting and helpful. As
Thank you.
for the economy, as for the issues that matter, at the moment it seems that the economy is really what's driving a lot of voters' interests and decision making. Um, we know about inflation. We know how hard hit many voters were in terms of inflation, and that's really what has been driving their concern. One of the most telling figures that we see in our polling is the number of people who say they're worse off financially now than they were a year ago compared to those who say they're better off. There are, in fact, 32% more people say they're worse off now than better off now. That's a devastating number for an incumbent party, in fact. If you look back to 2020, October of 2020, that was actually positive. People had a much more positive view of their personal economic circumstances. So when I'm looking at the election at the moment, I am thinking that the decision that maybe some of these undecided voters will make is really probably going to come down to their economic concerns. There are some other issues that I think are used symbolically, but that by the parties, and we can talk some about the reasons for that, and I know we want to talk some about polarization in the electorate, but for the most part, I think the voters are looking to think about how am I going to do economically? Because right now things aren't great for me, so I've got to make a choice that's going to make things better financially.
And Burwood brings up an interesting point about the polling, but this is kind of where, the financial advisors on this call and the folks at Fort Pitt are trying to give analysis versus an emotional viewpoint, if you will. A lot of people may feel somewhat negatively about the economy versus 4 years ago, but if you actually look at some of the numbers that are coming out from BLS, you'll see that even with Joe Biden's worst year of job creation, it's on a pace of roughly 200,000 jobs a month over the course of 2024, which would be the worst year out of the non-COVID years. I don't count 2021 when I do the analysis just because it was a bounce back from COVID. But if you compare Donald Trump's 3 pre-COVID years, the Biden's worst year at 200,000 still beats Trump's best year of 190,000 jobs added per month. You look at some of the other indicators in regards to American workers between the age of 25 to 54 being attached and fully employed in the workforce, the numbers still skew towards Biden. Now, if you look at the polls, if you listen to campaigns, it may not sound that way. But there's a reason why you're looking at what you're hearing on television per se when you're watching the nightly news or some of the politicized TV shows versus what the jobs numbers may say, versus the inflation starting to come back down, some of the other indicators in the market. So it's very important that when you're looking at the election, you try to understand a little bit more and you trust these guys on this call that give you some guidance as to, okay, from a longer term perspective, these are all of the considerations to take into purview, if you will, and make sure that you're not just looking at one snapshot here or one snapshot there. And in politics, The job, particularly of campaigns, is to make you look at one snapshot here, one snapshot there, and to make a decision. Where it's financial investment and long-term planning, whether it's from a civic perspective or from a financial perspective, is not to do that. It's to do the exact opposite of that.
Yeah, I would add, I think those are great points, Lenny. And I would just say something Chris said earlier about we're trying to be rational in our decision making when it comes to investing by looking at these fundamentals. Politics is about emotion, not rationality. This is why we've seen a rise in polarization. The political elite, in fact, our political leaders since the 40s and 50s have done their best to try to purge their parties of people who don't think in the same ways. And that's so they can have a more coherent ideological perspective. And that process has worked itself out for some time. And so that's what's led us to the current moment where really most of what's discussed in advertising today are those kinds of issues that are going to appeal to base voters and to really highlight the differences between the parties and not the kinds of things they might do together. And so, for instance, in 2024, the campaigns and their people who support them have already spent $350 million advertising in Pennsylvania. That's twice as much as any other state. And pretty much most of those ads are to try to tell you how different the world will look depending on who's in office. And, you know, that is an emotional appeal, not a rational one.
If I may, one final thing. I know that we may be jumping to questions as well, but Berwin brought up another one of Chris's wonderful slides, and that slide was how the market performs based on who's controlling the federal government, whether it's a Republican-controlled government, split government, or Democrat-controlled government. We're also at a crossroads, and Berwin brought this up in regards to the purging of the parties ideologically, but we're also seeing a little bit of a Freaky Friday type of dynamic. Because over the years, the Republicans were the ones that thought from a free market perspective, global economy perspective, we'll have free trade and the American work and the American way of life would benefit from that. And the Democrats were the one that were more isolationist when it came to economic perspectives and policies. Let's keep manufacturing in. Let's keep those trades in. Let's make sure that the American worker is making the goods, selling it to Americans, and everything's in-house. Well, if you look at starting in 2016, Barack Obama, the incumbent Democrat, was for the Trans-Pacific Partnership, that free trade agreement proposal for Asia. Donald Trump was against that policy. And since then, you've seen more of an isolationist tone from the Republican Party as a whole, which is much different than how they used to be versus what you are hearing from some of the Democrats. So even when you look at that chart that Chris brought up earlier in the presentation, the philosophies behind what those two parties were doing over the years has kind of flip-flopped a little bit, which again goes back to that whole, cross-section that Berwood just mentioned, the emotionalism of politics versus the rationality and perspective when it comes to making financial decisions. And then, of course, good leaders out of DC will find a way to blend both so that we can all win in that scenario.
Yeah, and I think that's just a final point before we go to Q&A. That's part of the reason I think that divided government tends to yield positive results, because first it's the stability, but also a requirement that there's the policy output is more moderate. It doesn't lean towards one particular ideological perspective or another. And so that sort of moderation, taking the best ideas that you can present and get to vote for, that I think that helps. That's a benefit, and many people see that as a benefit of divided government as well.
Excellent, excellent. Thank you both. So as I mentioned, we're going to start moving to our questions for the panel. We got a number of questions in advance, and we're going to try to get to as many of them as possible. If your question is not asked, please feel free to reach out to myself or your financial advisor here at Fort Pitt to make sure that those questions do get addressed. I'm going to start with you, Brad. What are some of the main questions and concerns that your clients are having as we lead up to the election?
Yeah, thanks, Dave. I think, it's kind of been talked about, Lenny and Burwood, you both touched on this. I think the biggest concerns we hear are ones driven by uncertainty. What would a Trump presidency look like? What would a Harris presidency look like? What does that mean for them? And to Dan's point, we've pretty much seen 4 years of each of them, so we've got a pretty good idea of what to expect. I think, unfortunately, there's so many preconceived notions out there that, to Chris's point, we're really trying to. I think we do such a good job as a firm, and the investment folks specifically, of kind of parking our personal opinions at the door, looking at things objectively, and saying, here's what is likely to come out of this. And the reality of it, with all the conversation we just had about divided government, is when you look at some of these um, proposed policies, proposed agenda items that have people concerned, I think the first thing we really have to do is help people take a step back and say, what's the likelihood that this is going to happen? I mean, I remember years ago there was really pretty serious talk or a proposal about changing how municipal bonds were taxed, that they weren't going to provide, tax-free income anymore. Had a client who was very concerned about that, and she asked, what should we do? I said, well, the first thing we should do is wait and see if this happens, because my guess is it's not going to happen. Some of the things that have been talked about as far as changing capital gains rates to the point of divided government, you're going to need congressional approval to do that. And it's very unlikely that either Trump or Harris is going to get the approval to do the things that they want to do. So I think our main job as a financial advisor is to really help people walk through this in a little bit more arm's length fashion to say, well, what's the likelihood that we even have to worry about this?
Great, excellent, thank you. So, with investors that have different risk tolerances and time horizons, are you making any adjustments to their strategies?
Really, I think it ties back. Dan made a comment about this in his portion, where I think those decisions are really unique to each person. And like our clients, everybody should have a financial plan, formulated strategy, and idea as to why they're investing their dollars the way they are. And unless there's a change to your circumstances, your time horizon, your income needs, your risk tolerance, then we don't change our strategy based on some of these, um, outside factors. We're going to see volatility. It's been happening all of our lives. It's going to continue to happen. But we're really working with our clients that at least once a year, we're sitting down and having a very real conversation about what is changing in their worlds, and do those changes necessitate a change to investment strategy. If we let these foreign, issues come into the picture, if you look at 2023 as an example, we had four really notable knee-jerk reactions, and the market went down significantly at each one. Probably the banking crisis is the most memorable. That's the one that people recall. And at each one of them, the market came back very, very quickly. And if you took the bait on any one of those four, or heaven forbid, all four of them, and moved out of your investments, and then the market recovered and moved back in, you had a very different result than our clients did.
Excellent. Dan, this one is for you. How do you expect the election results to affect interest rates, inflation, and overall economic growth? And does it matter which party gets in?
Yeah. So thanks for the question. I think a lot to unpack there. Let me kind of tackle those one by one here. On economic growth, I think, the very high level of government spending is one of the reasons that, economic growth has remained, so resilient, kind of against, the predictions of a lot of economists. And I'd expect that to continue under either administration. I don't think either candidate has really shown any indication of fiscal restraint. So, that would be a tailwind for economic growth. But we certainly do also wonder about or worry about the long-term implications of that spending. So, I mean, right now we're running 6 or 7%, budget deficits in a period of basically full employment and above trend, economic growth. Those are the types of deficits that we ran back in 2008 and 2009 when we were trying to pull the economy out of a major recession. We should not be, running or the same type of fiscal stimulus, today while the sun is shining. Interest rates, we look back to last fall, we hit 5% on the 10-year Treasury yield, and then we saw rates move all the way back to about 3.6% in September. So I'm pretty confident that we've probably seen the peak of interest rates at that 5% level, of this cycle. But I don't think we moved much lower than we were a month or so ago. And I think that really comes back to the impacts of government spending, budget deficits, and the debt load. So, we're probably going to have to borrow something like $2 trillion in the Treasury market next year to fund our deficits. And the market could certainly charge a higher price, to absorb that supply. And that higher price could be in the form of, higher yield. So I would expect a range of, let's call it 3.5 to 4.5% on the 10-year Treasury, which is kind of the benchmark that we look at in the near term. And then finally on inflation, I'd say, fairly pleased with the progress that we've made there since the peak of over 9% on inflation in June of 2022. We're down to, 2.3, 2.4% on headline inflation now. I think we're really going to be watching developments in the housing market very, very closely here. So we all know, we've talked about it a lot, the housing component of inflation, so shelter prices and rents, is really the main component of that equation. And, I think if we do see lower mortgage rates, next year, the real question is, does that translate into lower housing prices and lower rents as we see a lot of supply coming into the market as people can now sell and go out and buy another house with lower mortgage rates? Or do those lower mortgage rates just translate into an increase in housing prices and boost rents even further? So we don't know the answer to that question, but we're going to be watching, the housing market very closely as we enter 2025.
Excellent.
And Dan, can I just piggyback on that to say, I think part of our job is also to provide that perspective, because the reality of it is a 6% mortgage from a historic perspective, is a very good rate. We have a lot of clients who had 14 to 18% mortgages. And it's not going to be this way, forever, but I think it's our job to, again, provide that broader perspective and say, that shouldn't prevent you from doing something if you want to.
So speaking of perspective, Brad, what are you speaking about with clients as far as, how the market performance is going to be affected in the short and long term?
Yeah, that's a great question. I think we're not going to be at all surprised if, just like 2016 and just like 2020, we see a knee-jerk reaction at the point of the election. But if it plays out like it did in each of those, it is going to be short term. It is going to be something that isn't going to be concerning for the entire term. As I was looking at this, I did a little bit of research, and I looked at, and I was surprised at how tight the numbers were, what the economic, or I shouldn't say the economic, but the stock market results were under each a Trump and a Biden presidency, because I think there's a lot of people out there that were of the mindset that, if this party wins, the stock market's going to tank. If that party wins, the stock market's going to tank. And so when I looked at the S&P 500 from inauguration day of each Trump and Biden through September 30 of that election year, so in this case, just a week or so ago, I was shocked that annualized, the return under the Trump presidency was 13.5%, and the return under the Biden presidency was 13.6. It was unbelievably tight. So it goes back to the point that I've already made of, I think we have to, kind of take an arm's length view of this and not let our personal opinions, cloud the matter. And that is, quite frankly, the biggest benefit to working with a firm like ours, where we can really provide that distance, really look at things in a truly objective fashion.
Excellent. That's fantastic. Chris, for you, how far in advance do you think the markets think they know the outcome of the election? Is it priced in?
It's a good question. I mean, according to the efficient market hypothesis, it's always priced in. However, there are inefficiencies in the short term. And my personal opinion right now is I think the market's just complacent on not either. The market doesn't know which candidate's going to win. However, the market realizes that there will probably be gridlock, and it will just be a continued current pace of the last two administrations, both Republican and Democratic. So I like to look at what's priced into individual businesses versus the market as a whole, because to one of your points earlier, Brad, and I didn't want to interrupt you, is we might see some volatility after the election, whoever wins, and the market, the S&P 500 might go down 5-10%. Nobody knows. However, we invest in individual businesses. So some of our businesses might be up 10, 15, 20% in subsequent months and years. So that can offset a diversified portfolio of equities. So looking at the market as a whole and trying to figure out what's priced in is a gamble. So I don't think the market right now really knows who's going to win. I think the market is just complacent, and there's a lot of liquidity in the markets right now.
And if I may add to that, and not to go too far at all down the state elections rabbit hole, but with the investment in individual companies also comes, does the state where that company is headquartered or has a significant portion of their working base, is it headquartered in a state that either A, has an election, or B, has some type of significant issue going on that would impact that business positively or negatively? If you're talking about a business that's in Florida right now, in some instances, based on that business, it's more important these last two hurricanes, particularly what our fellow Americans went through just 24 hours ago, versus necessarily what may be coming out of the House of Representatives when it comes to fiscal policy. It's transverse to that is if you have an organization that's moving from California to Texas to take advantage of the corporate tax base, there's an opportunity there that you might not see at the federal level. But again, that's the reason why, the electioneering aspect of politics is one dynamic versus how politics impacts these type of everyday decisions for everyday Americans. It's a much different analysis.
Awesome. And actually, the second part of this question is directed towards you, Burwood. Do the markets pay attention to all the polls that are out there? And I've seen it. I mean, I was reading an article today on betting polls showing one candidate up over another, and then it depends on. There's so many different ones.
Yeah, look, polling captures our attention, and I think people who are into politics and are interested in understanding what may happen are very interested in the polls because they're our best tools for making a guess about the future. And so people pay attention to the polling. There are issues with polling, given the methodologies. We don't have time to talk technically about all the different ways that people do polling today and all the different incentives for doing those polls. But I think that if people are trying to gain some advantage in terms of understanding and predicting who's going to win, the polls give them the data they need. Now, again, whether it's going to have a significant impact financially, I mean, all the things that you've talked about here suggest that the campaigns are probably more of a distraction for the markets than anything else, given what we've seen. But I do think people pay close attention. If they didn't, no one would pay to do polls anymore, and no one would scramble to report on polls. And I mean, trust me, we see polls every day in bunches. So they play a role. And if we didn't have them, we'd find something else to do. In the 1830s and 40s, they used to get onto train cars and ask how many people were voting for each candidate. So, pick your poison.
Dave, let me just add one thing to that, because Burwood, part of your answer that caught my attention was, about the polls guessing. And, this goes back to the point that Dan made earlier. And I think it's worth underscoring that as we're working with our clients, we're really stressing with them that we're not going to make that bet, so to speak. We're not going to restructure a portfolio based on what we think will happen or on one specific outcome. If we were to do that and we were right, we realigned portfolios for that outcome and that outcome happened, we're going to look fantastic. But the reality of it is that is incredibly hard to do, especially with the one slide that Chris showed with the clean energy, completely, the exact opposite of what we would have imagined would have happened. So our job is to help people understand and feel comfortable with the fact that we're structuring portfolios for as many possible outcomes as we can, so that regardless of what happens, we're going to be okay. We may not, hit that home run if that one item happens, but the reality of it is that's unlikely. So we want to make sure that clients are best protected from all the outcomes that are possible.
Yeah, Brad, you sound sort of like a pollster.
Oh no! Oh.
Yeah, I mean, we also are interested in the fundamentals. I mean, good people who do solid research look at the fundamentals, not just the horse race, right? And so even though, in fact, if I produced a poll that didn't have a horse race, no one would pay attention to it. But we produce polls that don't just have the horse race. We produce polls that tell us all kinds of different things about what matters to voters. That's fundamentally much more important in understanding the dynamics of an election. And so pollsters, a good pollster is doing around the election what you're doing financially, looking at the fundamentals and all the possible things that might be affecting that, whatever it is you're trying to understand.
And
it warms my heart to hear that.
And to the point that the two gentlemen just brought up, it's when you're tying it to issues, you don't have to worry about being askew so much on personalities. And the example that comes to mind is, we all remember George W. Bush campaigning in 2000, talking about he wanted to be a compassionate conservative. He wanted to focus a lot of his presidency on domestic issues. So he comes into office in January 2001 with that intention, that focus. As we well know, by September of 2001, the rest of his presidency was going to be focused on the aftermath of 9/11. There is no president that comes into office and deals with exactly what they thought they were going to deal with. Even FDR, both came and had to deal with the Great Depression and also saw this rising threat in Europe. And before he knew it, he was a wartime president. So again, the bigger perspective allows for that flexibility to say these are things that are important to Americans, and therefore these are ways that Americans are going to act within the marketplace, not just socially, not just politically, but also financially as well.
And Lenny, that's something that Dan and Chris and their team do so well, that you've got your thoughts on what the world's going to look like, you've got your strategy, and when the environment changes, you've got to pivot.
Excellent. So we have about 5 or 6 minutes left. I guess the last question that I will ask before we finish this up and give everybody a chance to speak. Are there any recession concerns for or does it really matter which party is in office if there are recession concerns?
Yeah, I'll take that, David. I think we've probably taken a lot of the recession, concerns off of the table, especially compared to 2022 and 2023. I think a lot of that has to do with the fact that we have inflation coming down. Not only has the Fed ended their interest rate hiking cycle, but now have started to ease policy and cut interest rates. I think the job market in general tends to has held up pretty well. We still have 8 million unfilled job openings out there. Um, Companies have prepared themselves, consumers as well, for the higher interest rate environment. I think that has a lot to do with the fact, or why we avoided recession in 2022 and 2023. As Chris mentioned, looking out to 2025, and we are kind of at that point where the market starts to look at to 2025 and ask, what does corporate earnings growth looks like? Not that we're taking it as written in stone, but estimates look very, very healthy right now for mid-teens types of earnings growth. And I think a big factor there is we do expect that earnings growth to be more broad-based and evenly dispersed across the different market sectors, and not just the big technology stocks driving the bus or driving earnings growth. So I would say, the odds of a recession has definitely been, reduced compared to where we were over the last couple of years.
Excellent. And so with that, I want to give each of you the opportunity to, is there anything that you'd like to leave the audience with and make sure that they know and understand? Lenny, I think we can start with you and Chris there in Pittsburgh.
Well, first of all, I appreciate having the opportunity to be here today. And if there's anything I want to leave everybody with, is just the fact that, the American political system has gone through the topsy-turvies over the course of our history. And one of the things that maybe we all should be rooting for is, and Berwin brought this up, is a sense of divided government. The whole system of our government was designed for compromise, was designed for different ideas to pull each other back and forth so that the best and the brightest, that cream, can rise to the top. So if anything that you may be rooting for, it might be more rooting for people to have to work together and then find ways to do that, because that's going to bring about the greatest amount of stability and thus the greatest opportunity for growth.
Excellent. Chris?
Yeah, my final comments to leave the viewers with, essentially, we're long-term shareholders of good quality businesses. I mean, when myself, Dan, we're pitching a stock for the portfolio and the strategies, one of our bullet points isn't who's in office. So maybe there's regulation and geopolitical risk. Yes, semiconductors in China, that's obviously a big one, and both administrations have brought the hammer down. One might bring it down harder than the other. However, we already have curbs and restrictions on certain equipment over to China, and then China coming to here. So there are risks. However, you have to be able to put your bias aside and look at the numbers. So it's not really a joke, but I like to say, to be a good analyst, you have to be emotionless to an extent, where you can't get super giddy because your stock went up a lot, and you can't get depressed because your stock went down. You have to be in the middle, and you have to be very unbiased, clear, logical, and rational. So that's how we go about our investments. We want to know what we think it's worth 5-7 years from now, and we invest in it.
Excellent. Dan?
I think we covered a lot, not a whole lot from me, but I think our view is just that the best way through uncertainty is investing in great high quality businesses with solid management teams that are going to be able to navigate any environment that's thrown at them. We'll get through this election, and for most of our clients with 20, 30, 40-year time horizons, we're going to have a whole lot more to get through with presidential elections and midterms. It's part of the process. Volatility usually accompanies that process. As Brad knows, I like to say that market volatility is that price of admission for earning equity returns. Investors that take that long-term approach usually do very well. The investors that try to sidestep volatility or abandon their plan during a market sell-off, those are the ones that usually have big problems that need to be fixed. So, stay focused on the long term.
Excellent. Burwood?
Yeah, I don't have a lot to add except just a reminder that um, electoral politics is about emotions and it's about driving you into one of the two camps. And that truthfully, if you don't like the outcome, just wait because you got a midterm or you got another presidential election in 4 years. The other thing I think though that's important is that the presidential race sort of sucks all the air out of the room, and that's all we're talking about. But I think Lenny had alluded to it earlier. There's a lot of important stuff happening down ballot. And one of the things that I see is that there are a lot of people who vote for president and then they don't vote for other offices. So the roll off, the drop off between people who say vote for president and then Senate or for their congressman or for, importantly, their state house or state senator. Half the state senate is up this year. All of our state house races in Pennsylvania are up. There's a 102-101 narrow majority for Democrats in Pennsylvania. So just remember that we're not just talking about presidential election going on here, that there's a lot of other things to understand and to think about that might have even more direct impact on you in your everyday life.
Excellent. Thank you, Berward. And Brett, I'll give you the last word.
Yeah, and just before that, I'll piggyback on what Dan said, and he knows one of my favorite quotes is volatility is a fee, not a fine. And I know we're in the midst of volatility. It does feel like a fine, and fines are designed to be punitive and punish us, and fees are not. Fees are something that's what you pay to get something you want. And to Dan's point, that's a fee you pay to get what you want, which is long-term market returns. But I think my final thought would be, as I said before, we're really focused on really helping guide clients through these periods to help them be more long-term mindset, help them think about things more objectively. And it's really hard. When we saw the market go down 6% in the first 3 days of August, it's hard to have that mindset. August finished up almost 2.5%. That's indicative of the knee-jerk reactions we've been seeing. And I understand how difficult it is to remain calm when we're going through that. But that's what we have to do to be successful. So I think that's my final point to say we need to be thinking long term. We need to be thinking independently and objectively. And it is often hard to do that when we're in the midst of it, Dave.
Thank you. All right, so just a quick shameless plug. We do have a couple of other upcoming webinars. We have one coming up on December 3rd. So if you like this, please join us for that. Charitable giving, making the most of your donations. Again, that's on December 3rd. We have a number of downloads that you have access to. If again we did not get to your questions, please do not hesitate to give myself, Brad, or your financial advisor a call directly, so we're able to get that answered for you. And then just some quick disclosures there. And from there, thank you very much for attending today. Look forward to hearing and speaking with you soon. Thanks, everybody.
God bless.